So the next thing that I'd like your opinion on is the population, the younger population of Africa. Right now, people are talking about how young the population of Africa is and how young it's going to be in the next decade, which is 40% is 15 years and younger. This 40% is going to grow up and probably constitute the middle class of Africa, especially in the fastest growing regions of Africa. And institutionally, Africa needs to be strong to support that middle class that's upcoming. From banking standpoint, what does the financial institutions of today have to do in order to kind of support that massive population that is upcoming?
So I think that some of the characteristics that you're talking about Africa for today are very similar what they were probably 20 or so years ago in India or in Pakistan or in Egypt. They went through the similar kind of a population explosion or expansion. So some of the experience and learning that we had over there are very much relevant to Africa. So one of the things that you need to understand is that yes, population and it might be a crude way of putting it together, but it's basically a raw material. Yeah, so you've got tree as a raw material to make chair out of wood. So similarly, this huge populations in Africa, they are kind of a raw material. The question is that how will that material or that capacity or that resource be used to put into a good use. If you are able to put it into a good use, then it's a strength, and then you're talking about a growing middle class. If you don't put it to a good use, then it's a drag on everything, and then you will see a lot of unemployment, and then you will see related with unemployment other issues in the society.
Maybe crime.
A lot of crime, yeah. So those are the issues. Now the question is that so the opportunity, as we have determined, the opportunity is there, and everybody has to play a part, starting from the government to the various institutions, maybe the education institutions or whatever, and technology, on how are you going to. So let's say if you've got in similar problem like we talked about banks. So you've got a very big population and you've got limited schools in a developing country, then how will you solve it? So if you try to solve it through brick and mortar, the countries will not have the money. But if you have a solution to do education on digital platforms, then yes, maybe you have a chance of using that potential to good use. So similarly, when it comes to banking, and banking has been trying to solve that problem, or the governments have been trying to solve this problem, and the solution in yesteryear was a microfinance institution. So microfinance banks were there, maybe for the agri sector or for other blue collar workers or young individuals. You were coming up with propositions of serving them through a microfinance model. So there were products like your group lending, and you've heard about the Grameen Bank solutions in Bangladesh and all. So all of those solutions were there. Now for Africa, the advantage is that you can leapfrog some of those technologies, and those core models can remain the same, the learnings that you have had in your Bangladesh and India's of this world, and couple it with technology to better deliver at a lower cost with better controls. So I think that is how I would look at the Africa opportunity. The learnings that we have taken, because like I said, I have a passion on looking at the commonalities of people and region and their needs and their buying behavior rather than looking at the differences. So once you apply that approach, okay, it becomes very easy to solution. And now coupled with technology, so some of the problems that you may have faced in upscaling and delivering those services in a cost effective manner, now through technology you can solve them. So that's how I would really like to look at it.
All right. Okay. So I'd like to ask, just because you mentioned that you are intrigued by the differences and the commonalities between regions, which region do you think has done an immense, or your favorite financial infrastructure, like geographically, which you think has done really well?
So there's no one region that kind of ticks all the boxes. So in terms of, let's say, a more structured or a robust model, so that will definitely be more developed markets. Yeah. So let's say a system of a US or a UK is obviously better, not just from a business growth perspective, but how the whole, if I was to use the word balance scorecard works. So it's not just about growth; it's also about growing in a more controlled manner, and it's also about the customer protection rights. So that is something that is an ideal situation. So I would like us in Africa to be at that stage, okay? Because we do see some of our competitors exploiting the customers and everything, and then you are trying to kind of work your way towards it. So from an ideal perspective, I think it takes time. So more developed markets which have been around for a long period of time is good. From an innovation perspective, I'm very much excited about Africa. And within Africa, obviously, I think we all will agree. I've not been that much exposed about Nigeria, although I think it's a very dynamic market. I've been exposed in Kenya, and Kenya is a very, very exciting market. And Tanzania is very close behind it. There's a lot of learning that can transfer from Kenya to Tanzania. And then there are certain areas like agri sector is much more developed in Tanzania, and the opportunities are huge. So some of the fintech solutions applying in Tanzania, they can lead the market. But this whole East Africa as a region is very exciting, led by Kenya around innovation. So if you really look at a lot of silicon companies, they are actually coming and testing their products. Silicon Valley ones are in Africa in itself. And the good part or the differentiation that I see between some of the innovation that is happening in US versus in Africa, you see a lot of solutions which are focusing on making the life of people better. Whereas in the more developed market, there is a lot of innovation that is going into entertainment. Okay, so if you really look at and you want to put yourself on a pedestal and you want to really look at it, so the African solution looks more exciting to me because they are solving problems of people, whereas some of the more developed market, they are focusing more on
enhancement of their financial,
sending people to moon or to space and everything. So they are focusing on those things. Africa is focusing on making sure that people have drinkable water. So from that viewpoint, that excites me more.
Loan repayments, that's the main problem. The reason why financial institutions do not want to get into the unsecured lending space is because of the massive amount of outstanding loans that we have in this market especially. You don't know who you're lending to, and you just know that they're extremely risky, but you know that you need to still lend to them. But what are the strategies for repayment, for better repayments that you can drive in a region like this? And in the long term as well, how do you ingrain financial discipline across a volatile market or the volatile segment of Africa? What might be the best strategies to do it?
So one, there are 2 or 3 answers to this question. So one, when you say the loan repayments and high risk segment and everything, so that is an effect. So cause and effect, yeah. So the reason that somebody is not paying you back is that whatever assessment that you have done on that individual with the limited information that you had is incorrect. Okay. So that is one component that leads to non-loan payment. The other one, like I said earlier on, is the character. So even if you compare it with the corporate segment where you got all the balance sheets and income statements of a company for multiple years and everything, you see some of these businesses going bad because the external environment has changed and everything. So whatever product that they are making, they are unable to make it because the market has shifted or whatever, or some earthquake has hit. So there are some reasons which you can explain and justify. But then you come across those customers who have the whole capacity, their lifestyle is like the rich and the famous and everything, but they don't pay you. Okay, so that's a core character issue. So same thing applies on these customers as well. So in terms of your analysis, the challenge that you have is that it's very difficult for you to distinguish that these people who are not paying me, why are they not paying me? They don't have the capacity, or they don't have the character, or they're trying to avoid. And then you need to put in checks and balances to manage each of those kind of segments. I am a strong believer. It's not really a solution, but it is more of a check that there needs to be, in order for this business to succeed, there needs to be a good, strong, working credit bureau. Okay. So in the markets that we are operating in, not everybody is reporting the details to the credit bureau, which is a disservice, especially for some of the big players who have been around for a long period of time. They have developed their own database and they have got the experience. They are shy of sharing that information.
Why do you think so?
Because they have a competitive advantage
That's
keeping that information. So that's why they are trying to. And it is not the first time it has happened. It has happened in all the industries made with consumer banking and everything. And the regulator then comes in and says that nothing doing, you have to do that. Okay. And our regulators are doing the same thing, but still there are some gaps, which I think some of these things take time to sort out. And then there is learning as well. So the thing that disappoints me in that particular case is not the role of the regulator. They can be more tough, which is good for the industry, but it is more of lack of vision and understanding of those big players who are trying to kind of control the market in a way where they will not be successful. They are just buying time, which is not a good thing. So us, for example, we believe in not just our growth but the industry growth as well. So I think we should be very sharing the information extensively. So that puts in a little bit of,
control.
If I were to use the word, fear of God in the people. Okay. So then you will remove those people who are not paying you back because of the character related issues or who believe that they can cheat the system. So once you have taken them out, then there are some genuine people who are trying. So you can understand somebody who's running a business at a micro level is more prone to a business loss as compared to an SME, as compared to a MSME or a corporate bank or a big large corporate. So their life can change very easily. So there will be, it's a higher risk segment, and there will be higher loss. And in order for a business to sustainably run it, there will be a higher cost associated with these loans. Okay. Now, and that is criticized a lot in the industry. But yes, you can run an NGO kind of a system whereby you have some source of income coming in, and the main focus and the only focus is for the betterment of the people. But that's not a commercial solution. So a commercial solution need to come in with a pricing, not a prohibitive kind of rate, but enough for you to go out and lend out to the higher risk segment, have some kind of a control to kind of save out the people who are not looking at this as an opportunity which can change their life, who are there to cheat the system and manipulate the system. Once you are left with that group of people who are trying their best, then you should be okay with the higher loss as long as it is being compensated by the higher revenue. Now let me just give you an example, because we have done a lot of studies around some of the test case or testimonials of people who have taken these small loans and how it has changed life of these customers. So I still remember, because I was in some of these interviews. In certain cases we could communicate in English, I could understand. In other cases some people will translate, so I have a good understanding of what the guy is saying. So I still remember a banana seller in Mombasa, who basically in the beginning had some small money. He would buy bananas, get onto a bus and sell those bananas, and basically because he had limited money, so he would have to go to the market 2 or 3 times. So he would buy, sell, make some additional money, go out, buy some more bananas and sell, and that was his life. So the moment we were able to give out a nano loan to him, then number one, his cost of purchase went down, because he would go to a wholesale market and buy the bananas that he could physically sell one person in the whole day, rather than buying in small slots. And then obviously his capacity slowly increased. And now the interest, which may sound higher, these businesses, because they don't have very high operating costs, and they don't have elements like tax and everything for low end. So they can afford a slightly higher rate, and there is no other source of lending
Exactly.
available to them. And the solution that these institutions or fintechs are providing to them is a much better solution than the loan sharks that were there to give them loans. So it's definitely a step in the right direction. Yes, it can be improved further, but it's a good example. Now this is like on the base of the pyramid. There were other solutions where these people are, let's say, one step below the SME space. So there the requirement is slightly higher. You can do some sort of a credit assessment on them, which may include things like your existing operating structure. They may not have structured or audited business results, but let's say a simple visit to the workplace can give you a very good understanding that okay, if he's into some small manufacturing, that they have a machinery that is working, they've got the raw materials, they've got the resources, the guy has a good head, understands the market and everything, and then you can take a bet on that person. So that is, I think, solutions very difficult to do, and the bottom line is that these opportunities were there at a different scale always. It is the cost of assessment that was very high. So the moment technology is able to reduce this cost of assessment, then it's a win-win-win. It's a win for the bank, it's a win for the borrower.
Yeah, and the interest rates will also stabilize eventually, right? Once we...
Interest rates moving up and down, there are multiple variables to it. But obviously, as the business scales up, then whatever are your technology costs and everything can be spread over a bigger base. So that will interest rates may, that will give you the ability to be, let's say, more aggressive on your pricing. And similarly, as the industry develops, there are more players and everything, so then that competitive environment also supports the borrower.
All right, thank you so much, Zahid. It was very nice having a conversation with you.
Thanks a lot.
Thank you so much for your time. I'll see you
It's
around
a pleasure.
again.
Thank you.
Sure.
Bye.